Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures steady but lower today after the latest inflation print showed a cooling in wholesale inflation. Moves come after the S&P 500 and the Nasdaq snapped losses to close in the green on Wednesday. JP Morgan strategists signaling the worst may be behind us and that stocks could get a boost as pension funds, mutual funds, and sovereign wealth funds are buying the dip.
Plus, on the trade front, Canada's retaliatory tariffs on the U.S. going into effect today, while President Trump is taking aim at the EU, saying the U.S. would respond to the EU's countermeasures against his new 25% tariffs on steel and aluminum, raising the risk of further escalation in his global trade war. This morning, Trump threatened to enact a 200% tariff on European wine, champagne, and other alcoholic beverages if the EU follows through with a tax on U.S. whiskey.
And investors cheering Intel's new CEO, shares jumping today as the company announces a successor to former CEO Pat Gelsinger. Incoming Intel CEO Lip-Bu Tan has an engineering background and is credited with turning around Cadence Design Systems. That's a maker of computer-aided chip design software. Tan has signaled plans to stay with the company's strategy of making chips for other companies, despite its costly and challenging endeavor.
We're taking a look at U.S. stock futures this morning in the red, flat just barely to the downside for the Dow and the S&P 500. And then you've got the Nasdaq Composite that's lower by about 0.2%. This is all after this morning's data. The latest read on inflation came in softer than Wall Street estimates. And joining us now for more on this, we've got Yahoo Finance markets reporter Josh Schaefer. So yesterday it was all about CPI, today it's all about PPI, Josh.
Yeah, Brad. So wholesale inflation, the inflation that companies pay, right, that producers see before it comes to us, coming in softer than expected. Overall, you saw core PPI actually declining 0.1% month over month. That was one of the only declines we've seen in this period on a month over month basis in this 4 or 5 year period here that we've been seeing high inflation since the pandemic. So overall, a relatively solid report, I would say. But I think sort of what you're seeing in the equity market here is there's just a little bit of hesitancy on what sort of this good data means, right? You get a little bit of positive data yesterday with CPI, positive data today with PPI, but I don't think that's really where the market's necessarily focused right now, right? I don't think the market is necessarily concerned on February inflation data. The question is, what is the inflation data we're going to see in the coming months as we start to deal with some of these incoming policies from the administration, right? I think that's really where the focus remains right now, and the data from a month ago, it seems like the market kind of just shrugs it off, right?
That's and there's not data, Josh.
Right, exactly. Whose data is it, right? We don't know, but it's not the market data right now that the market really seems to care about. But I think the positive spin here would be we didn't get a bad surprise, right? Mm-hmm. And I think that's where people have been worried as these eco data releases have been coming out every morning is with a skittish market, if you get a very hot inflation reading or a very bad reading on something like growth data, that definitely is something that has been sending stocks lower. So I guess the positive spin would be at least it wasn't bad, but it doesn't look like it's enough to give us a rally in futures right now.
And I wonder what data point is going to matter the most next. We've been talking a lot about the importance of labor market data, but then you also have Stuart Kaiser saying that consumer sentiment data coming out tomorrow is going to be incredibly critical because how the consumer feels about the economy will impact spending. And then also you have JP Morgan saying we've hit the bottom and now we're so back. Where are you looking next when it comes to where the market's headed?
Yeah, I also saw a team point out retail sales next week, right? Mm-hmm. When we think about the consumer and the economic slowing being a big part of this story. Remember, the retail sales report for January was particularly bad. Normally, economists sort of write that off as well. You're coming off the December holiday spending season. It's a month-over-month report. There's some seasonal adjustments that are happening in January. But if the February report's also bad, then maybe we're actually starting to see a little bit of this consumer slowdown in the hard data. But to your point, Maddie, I think part of what JP Morgan was highlighting in that note this morning, saying the stock market has priced in a little bit more aggressive of a quote unquote recession or slowdown than other areas of the market, right? I mean, take a look at the bond market. The 10-year yield is still, what are we hovering at, 4.3 this morning? If we were really pricing in a recession in all areas of the market, I think you could probably argue the 10-year yield would be a little bit lower than 4.3%, right? You would see a lot more people taking that flight to safety trade. So that's definitely something strategists have been talking about. Yes, stock market is repricing its overall growth outlook, but you're not seeing that in every area of the market, and that's one reason people feel like, okay, maybe overdone selling in equities, and maybe there's room for a little bit of a comeback up. But when exactly that happens, there does not seem to be a big consensus.
Yeah, especially given that this is just the beginning of the policy uncertainty. We've got that looming government shutdown and, of course, anxious anticipation for any tax cuts to come. So a lot to still digest. Josh, thank you so much, as always. Well, Canada's reciprocal tariffs on $21 billion worth of American products are in effect as of today. Canada's Department of Finance warning, quote, unless U.S. tariffs and other unjustified tariff threats are addressed, Canada will apply counter tariffs on additional imports from the U.S. on April 2nd. The European Union also planning reciprocal tariffs on $28 billion of U.S. goods come April 1st. The president today vowing to respond. President Trump saying at the White House yesterday he will respond with additional tariffs.
As you know, we're going to be doing reciprocal tariffs. So whatever they charge us, we're charging them. Nobody can complain about that. I'll always have flexibility, but there will be very little flexibility once we start. April 2nd is going to be a very big day for the United States of America.
As the potential trade war continues to heat up, I want to bring in Tuan Wan, RSM's U.S. economist. Tuan, it's great to have you on here. I'm wondering where you are finding clarity amid this constant tit for tat on tariffs, on just how much of an impact it could have on our economy to have this policy uncertainty.
I don't think we're seeing much clarity, especially with the news today, on what's going to happen to European goods. And what we are really seeing right now in real time is the short-term pain, as you call it, from higher tariffs or the threat of higher tariffs on inflation, GDP, and financial conditions, like with the sell-off that we saw last week. And we have been very clear on the negative drag of higher tariffs on inflation and GDP, but I don't think anyone could have foreseen the kind of back and forth shifts in policy decisions on what countries we want to impose tariffs on, what products, and at what time, like the one that we're seeing at the moment. And I think we are really turning tariffs into a zero-sum game, just like a game of chess. When there has to be a winner, there has to be a loser. Otherwise, there would be a stalemate. And I think this is quite dangerous because the U.S. is willing to sacrifice short-term gain or like sacrificing a piece on the chessboard. But there are still many moving pieces on the board that I don't think we have calculated all the variation for this end game, and the financial market doesn't like this kind of uncertainties. And for our clients, especially the ones who have exposure to international trades, they are not also a fan of this kind of volatility.
Tuan, I wonder, as you're running your modeling, given kind of the fast and furious tenor that we've seen from the administration and leveraging tariffs either for kicking off negotiations for fair trade deals or just trying to ensure that there's some kind of elbowing and boxing out that's taking place early days in the administration. All of that considered, as you're running your modeling, how long until we see material impact from what you can forecast at this juncture?
In terms of inflation data, obviously in February, we didn't see a material pickup in terms of inflation from imported goods because we haven't seen tariffs on Chinese goods yet. We haven't seen tariffs on Canadian and Mexican goods yet. But I think in March and April, we're going to see a pretty big pickup in terms of inflation. And that's going to be quite troubling for the market because the type of slower spending that we saw in February is not going to last in March, especially when you look at the retail sales number. All the forecasts at the moment are pointing to a pretty sharp increase in sales for the month of March. So our approach at the moment is we really need to be cautious when it comes to inflation data and when it comes to spending data. We don't I think for our clients, we think we should be a little bit more defensive. Hold on to what we have at the moment and do not overreact to 1 month worth of data.
So that sounds like growth scare, but that doesn't sound like contraction. Are we reading that right?
No, I don't think we're going to see a recession anytime soon, even though we have upgraded our recession probability to 20% from 15%. But in the next 12 months, we still don't think that there's going to be a recession because the labor market remains very solid at the moment, especially given the recent job opening data. And I think this time again, it's going to be very similar to 2022 when the labor market will come to the rescue when it comes to recession scare.
Tuan, always great to grab some time with you. Thanks so much for joining us this morning.
Thank you.
Shares of Intel pushing higher today after the embattled chip company tapped a new CEO. Chip industry veteran Lip-Bu Tan will take the helm as CEO of Intel, replacing interim CEOs following the departure of Pat Gelsinger. Tan is a longtime technology investor and widely respected executive. He's got more than 20 years of semiconductor and software experiences, as well as deep relationships across Intel's ecosystem. Joining us now with more is the Futurum Group CEO, Dan Newman. Dan, just want to get your reaction to this pick. Good or bad for Intel?
I think it's really good. And if you look at the macro environment, everyone's seeking certainty right now. And I think this is the microcosm that is Intel. The market has been very uncertain. I do think that the folks that stepped up, MJ and David, that's the co-CEOs, did a nice job stabilizing things in the near term. But the market wanted the stability of knowing who the CEO would be, getting that kind of first initial outbound message to say, hey, this is our plan in terms of products. This is our plan in terms of the foundry. Lip-Bu was kind of a known advocate for this split, but it seems that he's kind of pulling back a little bit on that. And I think that's going to align to the Trump administration's understanding of the prioritization of America being able to make its own leading edge chip. So I think it's good. The market reaction is solid, but he's going to bring efficiency. It's going to bring questions about the split, but the certainty at the leadership of the company is what the market was looking for.
Are you looking for a continuation or a complete sea change when it comes to strategy from Lip-Bu Tan moving forward? And I ask in the context of this note he sent to staffers yesterday, talking about how he is expecting to continue on Gelsinger's plan to make Intel a top foundry. Do you agree with that continuation?
I do. I've been outspoken that I think the company does need to stay together. I think splitting it apart will devalue it. And it also puts some risk to the U.S. because we don't have a U.S. chip champion in terms of manufacturing. We saw the TSMC deal. That certainly brought some relief to whether or not we'll be able to make leading edge chips. But the IP primarily stays in Taiwan, even with the new R&D center. Intel products can feed the foundry. That's how it's always worked as an integrated manufacturer. But it also can get some gains from policy that will be pushed from the Trump administration that I think will kind of force the hands, hopefully in a way that ends up being valuable to all parties, but force the hands of fabless companies like NVIDIA, Qualcomm, AMD to look more closely at Intel. So there's going to be governance and policy requirements to make sure. But I think Lip-Bu Tan provides a bit of a encouraging ecosystem play. He led Cadence, a big EDA company. He's got great experience, and he was also outspoken against parts of the strategy. So I think he brings both sides. But I do think they need to carry forward together. I feel strongly about that. U.S. needs that chip champion. We need to be able to make leading edge. We cannot depend 100% on Taiwan.
Which is not exactly what Trump has said. He's talked about the CHIPS Act, saying that it's a horrible, horrible act, which is exactly where some of those dollars were allocated as subsidies for companies like Intel to really ramp up these foundry businesses. So I guess the question is, how much of that can Intel continue to bank on coming in their way and getting dispersed to them versus how much of that needs to come from existing free cash flow?
Well, let's be very clear. Trump has said a lot of things. He certainly likes to use the media and these sort of outbound communications to force action. We saw what happened with TSMC. They were going to invest here anyways, but maybe enhancing the investment, bringing more R&D here, bringing their leading edge here. But he's also been very clear that he knows the U.S. needs to lead in AI. We need to lead in semiconductors. We need to lead in computers, right? He said that all things are computers, that comment yesterday. And we need more manufacturing. So maybe you have to kind of look at two things at the same time. The CHIPS Act itself and how it was composed had some problems. We were giving a lot of dollars to SK and Samsung and TSM, non-US companies. So maybe it's more about the construction of the CHIPS Act, where those dollars go. And in the end, if we invest this money and, of course, use policy to make more manufacturing happen here, can we grow Intel more organically? Can we use dollars more efficiently? And perhaps not prop up companies that are non-US based ahead of US based companies.
So is now the time to buy Intel?
It certainly is a good moment from a sentiment standpoint. I do want to say the macro is incredibly complex. Every day, this kind of waffling back and forth on tariffs, but I am extremely bullish long term on AI, the deflationary impacts that it can have, agents, assistants. Companies will get more efficient first, and that will kind of counter any recession fears. But once we sort of see the acceleration, you will see the productivity gains, and Intel does stand to win, especially at trading at these low, near book value levels.
All right, Dan, we got to leave it there. Thanks so much for breaking down that news for us this morning. Appreciate it.
Thank you.
Coming up on Morning Brief, we'll count you down to the opening bell on Wall Street as stocks continue their move to the downside. Plus, shares of Adobe sinking on weak guidance. We'll discuss the recent quarter with Matthew Swanson from RBC Capital Markets and D-Wave CEO joining us to talk the quantum computing company's record fourth quarter bookings. That and much more ahead.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we got to take a look at shares of PLTR. Palantir hosting its 6th annual AIPCon today. This is the conference that showcases advancements in its artificial intelligence platform. Shares, they were higher actually pre-market. Earlier this week, we also saw shares jumping after the company's X account posted a 15-second video of the event. Palantir says more than a dozen customers will show how they are using AIP to drive innovation, including Walgreens, AT&T, and Delta, to name a few here. And as we were taking a look at shares here, just fractionally lower pre-market from what I could see on our screens, a few of the things that they're touting, and I do mean a few: more data, more robots, more automation. That's very simply put how they are approaching this year's AIPCon, and some of the announcements that could come forward remain to be seen, but ultimately it was really going to kind of hinge on how they're able to better and continue to position their software platform, which for those who are still trying to figure out like WTH, what Palantir does, they essentially offer better visualization for some of the large or big data trends that companies are trying to aggregate in kind of an all-in-one software platform, and their artificial intelligence has essentially supercharged that. The absolute value move from an options contract perspective looks like 6% after this event.
Wow.
Upside or downside.
So big potential move.
Potentially, yeah.
That's significant, right? It's interesting in the context of the run-up that we have seen in Palantir, especially since the election. This is one of those tickers that has withstood the volatility of the Trump bump, both to the upside and the downside. We're still up on Palantir since the election. Having said that, we did just get some news across the wire a couple minutes ago that I want to point out. Archer Aviation and Palantir are entering into a partnership for next generation aviation AI tech. As a reminder, Archer is an electric vehicle takeoff and landing company, basically looking into the future of eVTOL aircraft, and therefore they are a partner that might make sense for the likes of Palantir, given Palantir's interest in aviation as a form of defense. We are seeing that in the partnership details that we are getting in here, that Archer and Palantir are partnering on AI software that could be pivotal to shaping the future of aviation in the defense space. In particular, you've got Archer shares moving up here decidedly off the back of that news, up about 2.5%.
Yeah, some big new customer announcements and partnership announcements that we should expect over the course of today. Heineken, Walgreens, Racetrack, Ripcord, just some of the companies that they had talked about, and they've got some big speakers as well. We mentioned AT&T being one of them as well.
Lots of names to monitor there. All right, another trending ticker that we are watching, Adobe, reporting record revenue for its fiscal first quarter, topping expectations. But software developers' guidance for the current quarter failed to impress investors. You got the stock down 7%. Joining us to discuss, Matthew Swanson, RBC Capital Markets Director of Equity Research. Matthew, great to speak with you. What's your reaction to the earnings print?
Yeah, thank you guys for having me. First off, you know, it feels a little bit like we're sitting at halftime, right? This was always going to be a two-event sort of quarter where we had earnings. Then next week we go into the Adobe Summit, where we've always been thinking that's where we're going to start to get some more incremental Gen AI disclosures. There's also a lot of pressure around getting more disclosures around Express, but we can get more into that. The quarter itself, largely in line, reiterated the full year guide. The Q2 guidance was a little bit light, but I don't think it was anything to warrant the type of stock reaction we've seen.
Is AI both a gift and a curse for this company? And the reason why I ask that is because if you have more people that are opting into some of the AI tools, then that perhaps eliminates the need for some of the other pieces of software that Adobe offers. And I'm not sure how they're going about configuring and making sure that they are able to maintain their existing kind of license footprint at this juncture while also rolling out some of these new tools.
Yeah, and this has been the long-term debate around Gen AI since we started thinking about it, or AI more generally, is that if you get all these productivity improvements, do you start to see seat count reductions? I think the way Adobe's been thinking about it is the right long-term play, which is not focusing on kind of that instant gratification of consumption revenue through things like generative credits, but really trying to embed all of these new features within their existing product set. And when we think about that strategically, the reason we really like it is what you're doing is bringing people deeper into this stack that you've built over the last 40 years, and you've only seen 2 or 3 competitors in the last 40 years. In the standalone Gen AI models, we've seen hundreds of competitors come up in the last 2 years. So they're really trying to get into their core competencies. And I think that's where you can start talking about a lot of this new tech being kind of top of funnel for Adobe longer term.
But they still haven't found a way to monetize that new tech, Matt. And I wonder how much of a headwind, to Brad's point, that's going to be for the company, especially given all of the startups that are competitors to them who are making AI editing software, VX software that is so affordable and accessible. Why are consumers going to pay for Adobe when they can use CapCut for a fraction of the cost?
Yeah, well, and I think the conversation around monetization is really the crux of Adobe as a stock right now. And that's what we're hoping we get a lot more at Summit. Obviously, they tried to give us the breakout, the 125 million. And to some people at first blush, I think that number felt light. But you got to remember, one is these products have been out for 4 quarters. And this also only talks about what they would say is like pure standalone Gen AI, right? The Acrobat Assistant, Firefly, and then Gen Studio for performance marketing. When we were just talking about the majority of the Gen AI usage is being embedded inside that Creative Cloud. But what you can't do is say, hey, we did a 4% price increase. Now 4% of all Creative Cloud is Gen AI, right? That's not honest either. So I think this might be an area where the performance of Gen AI within the company is better than the way they're able to articulate it right now.
Should investors,
and I think that's been one of the big challenges.
Certainly. And so should investors, especially with names like Adobe that have had this propensity to acquire, to grow, as well as build out their own custom suite in the past, should they be anticipating a big acquisition, knowing now that the forum for a lot of the people and licensees who use their software, it's for the content to be able to go to the phone, the device that we're all carrying around all the time?
Yeah, well, and that's been a conversation for them around, organic versus M&A when you start looking at areas like the web and mobile. They had good numbers this quarter with 35% up year over year for creative and web and mobile. But that is like the next frontier when you talk about who the next generation of creatives are. And as you mentioned, like there's a lot more options for people that are getting into this space to start thinking about what types of tooling that they want to use. I think when you talk about Adobe's strategy, we heard about this a lot on the call last night, is this idea of one Adobe. And this goes back to that competitive idea. There's point solutions at every individual part of their business, but I think they feel they're most differentiated when you go from ideation all the way through the Experience Cloud to actually serving that marketing material. And so if you're thinking about where would they go, I think it's ways to make end-to-end further, right? So I think you want to move further into probably that marketing suite to differentiate in the enterprise.
Certainly. A lot of the Yahoo Finance users probably lighting up the Adobe page here today, this morning, going in to the start of trade here. And they're looking at this PE ratio of about 29 right now. Is Adobe fairly valued? Is this a company that has a longer runway from your own forecast?
Yeah, no, I certainly do think that it's undervalued right now when you compare it to mega cap peers. I think they've shown a remarkable ability to sustain margins while they're building out all this Gen AI technology. And also, I mean, if we're going to punish them for not being able to fully monetize it, we also have to understand that a lot of this cost they're seeing from Gen AI has not had direct revenue offsets. So I think from a profitability standpoint, we certainly see the strength. The other side of it, though, obviously, is the long-term revenue runway. And I think what we're kind of both saying right now is this idea that TAM is getting bigger, right? Gen AI is making marketing bigger, it's making advertising bigger, it's making digital bigger. And when you're talking about the largest player in that space, I think the question more is, why shouldn't they benefit than what we feel like right now in the narrative, which is trying to constantly explain, why they should.
Yeah, all fair points. Matt, thanks so much for taking the time, breaking down all things ADBE, ticker symbol, this morning. Appreciate it.
Thank you for having me.
You got it. All your markets action straight ahead. Stay tuned. You're watching the Morning Brief.
And you are just seconds away from your opening bell on Wall Street, ringing there at the NASDAQ and the New York Stock Exchange. Let's get you a check on the markets to kick off the trading day here. Taking a look at futures for a second as we wait for our boards to digest here. Over the last 4 days, you can see that market recovery that we had yesterday leading us just above the flat line. Will we be able to eke out gains for the week and buck the trend that we have unfortunately been seeing in the market as of late of weakness? That is, of course, the key question here. Let's take a look at the NASDAQ intraday, see how we're doing there. If I can get the board to low, you're still looking at losses around 0.3%. Your S&P 500, you're also looking at losses down about 0.2% here. I want to see how we're doing in terms of the sector action here. Interesting to see your tech names in particular when we look at this board continuing to struggle this week. You've also got financials continuing to struggle this week off the back of that weaker than expected inflation data. But let's take a look at your Mag 7. Interesting to see this bifurcation in the names. You've not got a lot of bifurcation actually, because you've barely got two names in the green. NVIDIA up about 0.6%. Microsoft just above the flat line. You've still got some struggle on Apple that's continued over the course of this week. Amazon, Google, Meta still struggling, and of course Tesla down about 1%. I'm just going to lastly really quickly take a look at what we're seeing in the Treasury space here, because it's been interesting to see what's happening in yields off the back of economic data. We've actually been seeing yields ticking up, and we're continuing to see that this morning. This indicating that the bond market is caring more about policy coming from the White House than they're caring about that economic data. Will that continue is a key question. But let's kick it over to Jared Blickery for a look at what's moving. Hey, Jared.
Thank you, Maddie. Let's take a look at the S&P 500 year to date. We can really see the extent of the decline right now that peaked in mid-February. In fact, those were the record highs. And so the question is, are we going to rebound? Are we going to go up from here? Are we going to go down? It seems to me the market is at a razor's edge. And I've been told we have Ryan Dietrich in the house. And so let me just spout some seasonality stats with here. Today is supposed to be, and this is March 12th, supposed to be the last day of declines for the month of March, according to a seasonality map. I have two in here. One of them, which is similar to his, bottoms today. The other is on the 19th next week. But the bottom line is here, we're probably due for a rebound. Doesn't mean it has to happen, but there are some things in place that suggest that it might happen. I'm going to skip down to the VIX right now, and let's take a look there. It has been holding under 25. Here is the year to date, so you can see well off of the highs just there. And while it's arguably a chart crime to draw a trend line on the VIX here, we can see it is just barely breaking that downward sloping line. So might be some relief for people who have been experiencing higher volatility now. We've also seen a huge surge in put volume. Sometimes that is coincident with a major market bottom. So it just gets back to my underlying thesis that we are on the razor's edge right now. Here's a 10-year T-note yield up to the highest yield that we've had in a couple of weeks, in line with what Maddie was saying. And then the US dollar index up for 2 days. I don't know if this looks like a bottom just yet, but it's trying to get there. Let's take a look at the sector action one more time, and I'm going to switch over to a 4-day look. Not too much going on today. Here we see energy in the green, the only sector in the green, and we have some cyclicals leading down. Consumer discretionary is right there, but so is communication services and tech, and we also have staples in the mix and industrial. So interesting to see a lot of the mega cap sectors just really getting hit. And this is a 4-day look that we're seeing on the NASDAQ 100 versus some of the more defensive sectors. And here only NVIDIA of the mega caps looking at some gains this week. NVIDIA just coming off of its best day, I believe, since January. And then Apple. Apple is in the midst of a fourth day of losses, so we'll see what comes today. Here's the daily look, and once again, Apple down about 1%. I want to get to futures, and there we are seeing gold just inch higher, so that's good enough for a few days streak, and it is now within 1% of a record high. And let's see if I can find GC equals F on here, and there we go. It's up 0.3% today, and let's put the year-to-date on there. Not quite back. Looks like we almost got to record highs here, so we'll have to check that on the way out, but still short of 3,000, that big psychological level. As usual, I'm going to close with Bitcoin. Bitcoin under a little bit of pressure over the last 24 hours, but not even down 1%. All I can say is the volatility is dropping. Here's a year-to-date look, and we can see, is this a bottoming formation? I think it's too early to tell, but the 200-day moving average right there underneath the lows, that has held. So bulls maybe have the edge very, very short term. Back to you guys.
All right, Jared, we will summarize today's hit as chart crimes with few charges and fewer convictions. How about that?
I love it.
Thanks so much, Jared. Appreciate it. It's time now for today's strategy session. Has the market found its bottom? That's the big question. After a week of swift and steep declines, stocks are looking steady right now. So what is next for the S&P 500 after nearly entering a technical correction? It was down 9% from its peak. 10% is that level that we would be watching for the correction. Joining us now, we've got Ryan Dietrich, good friend of the show, and Carson Group Chief Market Strategist, his more formal title. Great to see you here this morning. So as we're thinking about that very question, have we seen the worst behind us from what the technicals are telling us?
Yeah, Brad, thanks for having me back. And Jared just gave a nice shout out to some of our work there. I mean, just from a purely seasonal point of view, you tend to bottom in March. I mean, I came into the year, and I know I came on your network talking about this, early in a post-election year, stocks don't do well. Early after a 20% gain the year before, stocks don't do that well. The last 20 years, the first quarter has been kind of weak. Now, the big question is the worst over? Listen, we're close, right? We're close. I mean, a lot of ways I could take it. I'll go this route. So we've had about a 9% correction. Maybe we go into an official 10% correction. But what's really neat about this, I like to say follow the credit markets, right? The credit markets are the smartest people in the room. Keep this simple for the listeners. Look at spreads on triple B spreads and corporate spreads. There's not as much stress right now, Brad, as there was in early August when we had that 8%, couple-day pullback on the very scary yen carry trade unwind. So we're not minimizing the red that's out there. Like you mentioned, the Mag 7. Obviously, a lot of people, unfortunately, have gone overweight the Mag 7, so this feels a lot worse. If you have a diversified portfolio, bonds up a couple percent, Europe up 10%, gold, like you just said, up 10%. Yes, the S&P is down, but there's some sectors that are actually hanging in there. So after a 70% rally the last couple of years, maybe this was just necessary. And we get the headlines, we get into that. But we were saying expect maybe a choppy first quarter, and boy, oh boy, it's March Madness. It's here.
It's certainly been choppy. One thing that I'm looking at, Ryan, is the AAII survey of investor sentiment. As you know, it's now at 59.2% bearish. Bears have been above 55% for 3 weeks. That's only happened one other time, and it was 2009. Ryan, is the bearishness just building to a point where even if the technicals are telling us there could be something positive ahead, the bearishness is just too intense to ignore?
Well, great question there, Maddie. I mean, listen, when you look at sentiment, right? There's an old saying, if everyone's thinking alike, someone isn't thinking. General Patton, I like to use that. If everyone's bearish, the sellers are already exhausted themselves. Now, I'll be clear. I think this AAII, I cite it. Everybody cites it. It's a lot of people that got heavy in Mag 7, okay? And that's why they're feeling the way they are. But reality is I get to work with financial advisors every day. I get to talk to their clients every day. I mean, I get those little internal messages to myself. There is a lot of fear. And we know it's political. We know it's because we just virtually had a 10% correction pretty darn quickly. Mag 7's lower. But the negative sentiment is a positive, right? I mean, I say it like this. Markets can go up on good news. We know that. They actually can go up on bad news. 5 years ago right now, we made a bottom. We went up on bad news. What they don't like is uncertainty, right? 47 times the word uncertainty was in the Fed's beige book last week. That NFIB Small Business Survey, record number of the word uncertainty. So we do need some certainty on the trade front, but that doesn't mean the market has to stop going down. I mean, our market can stop going down. It can maybe consolidate a little bit. And again, the credit markets aren't showing major stress. That to me is the sign that this is not going to spiral out of control. One more quick one here. I just did this before we came on. Back to World War II, I found 48 times the S&P 500 moved into a correction. Now that's on a closing basis, so that's down 10%. We haven't done it this time, but really close. How often does it go to a bear market? Only 13 times. That's 25% of the time you go into a correction. Do you go into a full-fledged bear market? So our take is maybe we go into a correction, but we do not see a bear market coming. And again, early in a post-election year, choppiness is normal, and that's kind of what's happening.
Will the relief that the markets are looking for be the absence, perhaps in the next earnings period, where fewer companies are not only kind of adjusting their full year outlooks, but also using the word tariff a lot less?
Yeah. Well, let's hope so. I guess hope's not a strategy, but listen, I mean, we know the tariff concerns are there. I mean, profit, one thing to remember, right? We're hitting record earnings. You mentioned earnings, Brad. I mean, everyone knows that. Earnings in the fourth quarter up 17% year over year, was expected to be about 11 or 12. Listen, that's what we've done for me lately. What are you doing for me next? We do have new cycle highs in profit margins. Now, with all the tariff stuff going on, we're going to, I mean, listen, if all the tariffs that are being floated out there, what's the latest? 200% on alcohol coming from Europe. That one just hit. I know it can change in a hurry. You're going to see some hits to earnings. I mean, the market is repricing risk. That's what we're going through right now. That's why we pulled back 10% and more in other areas, because you're repricing risk, repricing potentially growth. We came into this year saying 3% GDP growth. Listen, we don't think that's going to happen now with some of the uncertainty that's out there. We're still low 2% GDP growth. That's not great. That's not terrible. We averaged 2.5% GDP growth for like 2 decades. So we're just repricing some growth here. But then the other thing, we haven't even talked about inflation. I know the reaction in yields, and you guys talked about it before it came on. I think a lot of the reason U.S. yields are higher is because of what Germany just did last week. Germany brought out the bazooka. Their 10-year yield had like a 4 or 5 sigma event, which is not supposed to happen in our lifetime in terms of the higher yield. So maybe global yields are perking up. But in inflation front, there's still some good positive things. In our base case, the Fed's probably going to cut 3-4 times this year without a recession. That's going to unlock housing and unlock some confidence in small business. Trust me, it's worrisome out there. There's some concerns, but there's still more reasons than not to be optimistic in our view.
Ryan, you've been talking about those investors who went overweight the Mag 7, who are now feeling the pain of those decisions and that investment strategy. What are the technicals telling you about what's next for that basket of stocks?
Mm-hmm. Well, listen, great question there. Extremely oversold. I mean, that's striking the obvious thing. But I'll tell you like this. I mean, I can't really talk individual equity names, but you guys listed a bunch of them, and some of them are cut in half, right? If you liked some of these companies a month ago on February 19th, when the market was making new highs, you should really like them now. And the market psychology, I work with investors all the time. If you like something up here, you don't tend to like it down here, right? Rebalancing, buying when things are cheap. What's the other saying? Stock market's the only place things go on sale, but everybody runs out of the store screaming. I mean, I think there's some really good valuations right now in technology and communication services, groups that we weren't too crazy about. Well, we were more neutral technology. We're okay communication services, but now there's some really good values out there. So if someone wants to kind of, I hate to say catch a falling knife, because that's what it feels like, but you can take some profits if you weren't in those names and get in them now. But if you've been in them, I think that's just a reminder to investors why you should stay diversified, why you should rebalance, and don't always chase the shiny object, because it can burn you sometimes. And we've seen that, unfortunately, with a lot of people. Made a lot of money on Mag 7, but now it's not so good. And you look around, and financials, other groups are hanging in there this year. But if you're tech heavy, it hasn't been a fun year.
It certainly hasn't. Ryan, thank you so much for joining us. Always appreciate your insights. Thank you.
Happy March Madness, everybody. Thank you.
Happy March Madness. We'll come to you with all of our March Madness questions. Coming up, D-Wave's CEO Alan Baratz is going to join us to discuss what's next in the quantum computing company's most recent quarter. We'll be back with that. Shares of quantum computing company D-Wave are higher, up nearly 18% after the company's revenue for the fourth quarter topped estimates, though adjusted net loss for the 3-month period was wider than anticipated. Customer spend more than doubled during the year. Bookings for 2024 surged 128% to nearly $24 million. Now, some anticipate quantum tech's high-speed ability could unlock major advancements with AI. That enthusiasm has boosted quantum stocks, including D-Wave, over the last year, though some critics, including the likes of NVIDIA's Jensen Huang, have cast doubts on the tech's near-term utility. Joining us now with more, we've got Alan Baratz. He's D-Wave's CEO. Alan, great to speak with you. Obviously, a huge lift in the stock this morning. Just curious from your perspective, what drove this massive increase in customer demand over the last quarter?
So first of all, Madison, thank you for the opportunity to join you this morning. I very much appreciate it. A significant component of our increase in bookings in Q4 of 2024 had to do with the first ever sale of one of our quantum computing systems. We sold it to the Jülich Supercomputing Center in Germany. Up until now, our primary business model has been quantum compute as a service. Customers pay us on a recurring revenue basis to access our systems, and it takes time for that revenue to grow. But when you sell a system, you get a one-time significant hit in bookings and revenue.
And so with that in mind, as you're thinking about the outlook from here, how does the pipeline look as you're ultimately finding some of these new partners to believe in this technology as you're scaling up even more so?
Yeah. So the pipeline looks very good right now. First of all, this particular system sale had a lot to do with the fact that just yesterday we announced that we had, for the first time ever in the industry of quantum, achieved quantum supremacy on an important, useful, real-world problem. In other words, we are able to solve a problem on our quantum computer that cannot be solved classically. That was of great interest to the Jülich Supercomputing Center and was really a significant driver of this system sale that has also started to generate a fair amount of interest across a number of other research institutions and government labs who are interested in themselves perhaps owning a system and being able to do similar research on that system.
Yeah, what is that quantum supremacy breakthrough that you're talking about, the ability for your supercomputer to do something a computer simply cannot do? What does that do to the argument from NVIDIA's CEO that quantum computing is just too long-term? It's not a near-term enough solution for investors to really be buying.
Well, basically, it clearly points out that he was incorrect. And I've talked about this in the past. Different quantum computers will mature over different periods of time. At D-Wave, our quantum computers are mature today. They are commercial today in the sense that we have customers that are using the system today as part of their business operations. And now we have also announced that our quantum computers can solve important problems that cannot be solved classically, full stop. Now, there are other approaches to quantum computing that will take longer to mature. So, Jensen wasn't wrong with respect to some of those other approaches to quantum computing, but he was wrong when he lumped all quantum computing together, because D-Wave is very different from everybody else in the industry.
What is the energy requirement like in order to run quantum computing at this juncture, and how do you see needing to kind of scale that lower, or maybe you need to ramp it up even higher because there will be more quantum computers?
So thank you for asking that question. Our quantum computer is very energy efficient. It requires about 12 kilowatt hours. So that is quite different from the hundreds of megawatts that we're talking about for the hyperscalers. Moreover, that power consumption, 12 kilowatts, has remained constant through every generation of our technology, from 256 qubits to 1,000 qubits to 2,000 qubits to 5,000 qubits. The energy remains constant. The reason is we're superconducting. That power is required for the refrigerator to cool down the chips. The chips consume no power themselves. And in fact, we can put multiple chips in a single refrigerator. This actually means that we're far more energy efficient than classical computing. And we think that that could open up some significant opportunity to use our quantum computers for AI and machine learning to reduce the power required in those areas.
I wonder, too, how you're thinking about potential competition in the space. We know the likes of Amazon, Google, and Microsoft have also been working on quantum computing and have introduced their own quantum computing chips. Are you concerned at all about them taking up market share in the space?
So there are different approaches to quantum computing. Our approach is actually quite different from those of pretty much everybody else in the industry. And I won't get into the technical details, but we started with a technological approach called annealing, whereas everybody else is pursuing gate model. Annealing is quite different in that it's a much easier technology to work with, and that's why we are commercial today. And the others are quite a few years away from being commercial. But moreover, annealing is good at solving different classes of problems than what gate is good at solving. So business optimization problems, frankly, most of the important hard problems businesses need to solve, like workforce scheduling, our quantum computer is very good at addressing those types of problems. Quantum chemistry, that's the domain of gate model systems. So we don't really compete with the gate model approaches to quantum computing.
Alan, thanks so much for taking the time here with us. Always fascinating to learn more about the company and the space as a whole. It's lighting up the Yahoo Finance platform today. Appreciate it.
My pleasure. Thank you.
Let's check in on shares of Intel as we head to break. They are higher by 15%, this off of the announcement of their new CEO. We'll continue to keep tabs on shares of INTC. We've got more ahead on Morning Brief. We're taking a closer look at some trending tickers this morning, doing these ones in 30 seconds each. Let's go. First up, Microsoft raised to buy from neutral at D.A. Davidson. The analyst Gil Luria saying the software company has shifted to a more rational CapEx strategy. He also highlighted that the company has forecast flat sequential CapEx over the next couple of quarters and lower growth into fiscal 2026, which will help protect margins. Additionally, he calls Microsoft the best positioned out of what he calls the Magnificent Six companies for a consumer slowdown, since it has the least consumer exposure. Shares are down fractionally.
And taking a look at shares of Cloudflare as the company receives a slew of price target cuts this morning. Still, the company has 16 buys on Wall Street, 16 holds, 4 neutral ratings, no sells. Mixed outlook for the company amid a slew of price target downgrades. As we mentioned, the stock down 5%.
Plus, Wells Fargo shares, they are lower despite RBC Capital Markets actually upgrading the stock to outperform from sector perform, saying the stock's weakness provides a good entry point. The analyst Gerard Cassidy says Wells Fargo has executed on its plan to satisfy all of its regulatory issues while increasing profitability. Shares flat, just barely to the downside right now.
All right, and that is going to do it for the Morning Brief this morning. You can join me next hour for more analysis on Catalyst, and then stick around for Brad with more on wealth. Stick around.